Welcome to our Research and Development Tax Credits webinar. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits to our clients. Our team is a diverse mix of tax specialists, attorneys, and engineers from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. Now I'm going to introduce our presenters. Michael is a senior manager with KBKG and advises clients on tax matters related to federal and state research and development tax incentives. He has 20 years of experience working on tax reviews ranging from sophisticated multi-year claims to short-term consulting projects. He has advised numerous Fortune 500 clients across a variety of industries, including aerospace and defense, manufacturing, agriculture, pharmaceuticals, communications, industrial products, consumer goods, software technology, and energy. Mike Niss is a senior R&D tax credit specialist at KBKG. Having an educational background in both accounting and biochemistry, Mike started his career in the biotech industry, manufacturing pharmaceuticals for Fortune 500 companies such as Amgen and Baxter. Since transitioning into public accounting 5 years ago, Mike has obtained considerable experience in both tax compliance and specialized tax consulting services for a variety of industries. By applying this industry knowledge, Mike has been able to provide his clients with valuable insight into the details of their research expenses. Now, I turn this presentation over to our speakers.
Thanks for the introduction, Jackie, and hello, everyone. This is Mike. We appreciate the opportunity to work through this webinar with you guys and outline the R&D tax credit study today. So here's an agenda for the items that we're going to cover during our webinar. We'll start with a brief legislative update. Next, we'll discuss the R&D credit opportunity. Then we will cover the tax definition of R&D activity. We'll explain the two federal calculation methods and walk through a couple of examples to show you the mechanics. And then finally, we'll wrap up by discussing tax planning and audit strategies. Additionally, we encourage you to submit your questions in the chat box, and we will try and answer as many as we can as we go through this. All right, let's get started. So the Section 41 credit for increasing research activities was originally enacted in 1981. At the time, it was a temporary code section and stayed as such until it was permanently extended as part of the PATH Act of 2015. The Section 41 credit is a federal statute. However, most states offer some form of research credit that borrows from this federal statute. And although there are billions of dollars worth of research credits claimed every year in the United States, there are still billions of dollars of credits that go unclaimed. This is primarily due to many taxpayers not being aware of the credit or not quite understanding it. This webinar will attempt to clarify some of the nuances of the R&D tax credit. So the PATH Act made three very important changes to the R&D tax credit. First and foremost, the R&D credit has been permanently extended, allowing taxpayers that have traditionally taken advantage of the credit to continue to do so. The second big change is that the R&D credit can now be used to offset a portion of payroll taxes for qualified small businesses. And lastly, eligible small businesses can now use the R&D credit to offset alternative minimum tax. So effective for years beginning after December 31st of 2015, qualified small businesses can now use up to $250,000 of research credits to offset a portion of their payroll tax. A qualified small business is defined as a person or entity with less than $5 million in gross receipts and no gross receipts before the 5-year period ending with the current period. For example, if a taxpayer wanted to make the election in 2019, the taxpayer could have had no gross receipts prior to 2015. If the taxpayer had gross receipts in 2014, this particular taxpayer could not make the election in 2019. Additionally, taxpayers cannot make the election for more than 5 years. So this is what we refer to as the 555 rule. Can't have had more than $5 million in gross receipts in the current year. You can't have had gross receipts for more than 5 years, and you cannot elect for the payroll credit more than 5 times. Please note that gross receipts are not required in order to make the election. Therefore, a company that has no gross receipts but does have payroll taxes and a research credit can make the election. If a company is not a partnership or S corp, only the amount of R&D credit carry forward can be applied to offset the payroll tax. The election starts the first quarter after the federal return is filed. If a taxpayer files their 2019 tax return in, say, March of 2020, the election will apply to payroll taxes beginning in the second quarter of 2020. Startup companies in a multitude of industries are great candidates for the payroll tax offset. For example, startup biotech and software development companies should review their potential as it pertains to the R&D credit. Generally, these startup companies were in a net operating loss position and not generating a tax liability. Now the credit can be used to offset payroll tax expense and generate a large cash benefit. So here's an example of how payroll tax election can help a qualified small business. In this example, a software developer begins operations in 2017. The company is comprised of 15 individuals and did not receive any gross receipts until 2019. In 2019, the company had $800,000 in gross receipts and qualified wages of $2 million, resulting in R&D credits of $200,000 and a payroll tax liability of $125,000. This company will file their 2019 tax return in March of 2020. Prior to the PATH Act, the taxpayer could have claimed the research credit, but would not have been able to use any of those credits until they had taxable income. Due to the PATH Act, they will be able to offset the qualified portion of their payroll taxes in the second quarter and going forward. Any of those unused credits will be carried forward to those subsequent quarters. The AMT provision in the PATH Act is equally as valuable to taxpayers. Prior to the PATH Act, research credits could not be used to offset alternative minimum tax. Taxpayers in AMT were forced to carry their credits forward until they came out of AMT. But now, eligible small businesses, defined as averaging less than $50 million in gross receipts the previous 3 years, can now use the credit to offset AMT for tax years beginning after December 31st of 2015. This provision is similar to a previous small business provision that was enacted in 2010. One item to note in the AMT reduction is that it is not available to publicly traded companies. So prior to the PATH Act, taxpayers that had an AMT liability could not use the research credit to offset taxable income. In this example, the taxpayer generated a research credit of $300,000. Their tax liability is comprised of $158,000 of regular tax and $23,000 of AMT liability, amounting to a total tax liability of $181,000. This taxpayer could not use any of their credits in 2015 and were forced to carry their entire R&D credit forward. For tax years beginning in 2016, taxpayers in AMT are now able to use the research credit to offset their tax liabilities. In this example, the taxpayer generated $331,000 of research credits. Their tax liability is comprised of $188,000 of regular tax and $31,000 of AMT, resulting in $219,000 of total liability. Applying the Section 38 rules as well as the new rules surrounding the PATH Act allows the taxpayer to offset $178,250 of tax liabilities. Prior to the PATH Act, this taxpayer would have had to carry their entire research credit forward. As a result of the new rules, This taxpayer will offset a large chunk of their tax liability and carry forward the excess credits. So by eliminating the AMT's tentative minimum tax for corporations, the law allows the research credit to reduce a taxpayer's liability down to 25% of the amount of net regular tax liability that exceeds $25,000. This is a limitation imposed by Internal Revenue Code Section 38C. So that's how we're coming to that 178,000 that you see there. Is it's basically taking the tax liability minus the limitation of that 40,750, which is calculated by taking that 188,000 of regular tax liability minus 25,000 times 25%, or the 2020 or the 25-25 rule as we refer to it.
Let's go ahead and dig into what the R&D credit is. So the research and development credit is a general business credit, and as such, it provides a dollar-for-dollar reduction in a taxpayer's income tax liability. The credits are subject to IRC Section 39 carryback and carry forward rules. So as such, any unused research credits would be carried back 1 year first, and then forward for up to 20 years for federal purposes until they're used up. The credit is available to corporations and individual business owners, as well as pass-through entities such as S-corps, partnerships, and LLCs. In case of the pass-through, the benefit flows through to the individual shareholders on each shareholder's respective K-1. This chart represents the total amount of federal R&D credits claimed since 2008. It's estimated that over $18 billion of R&D credits will be claimed by companies in 2019. And this chart represents the size of the businesses that are claiming the federal R&D credit. About 87% of companies that claim the credit have revenues in excess of $100 million. While the remaining 13% is split between companies with revenues less than 100 million and less than 10 million, respectively. Now, there's no cap on the amount of the credit at the federal level, so we encourage you that if you have a client or if you are a company that can benefit from these R&D credits, make sure that you're aware of the credit and the rules. With changes resulting from the PATH Act, we anticipate that the small and mid-sized companies are going to start claiming a larger share of this pie going forward. So now would be a great time to revisit this with your clients, make sure that they're not missing this opportunity. The federal R&D credit offers roughly 6.5 cents for every dollar spent on qualified research activity. In addition to the federal credit, many states also offer R&D tax incentives as well, mostly for R&D taking place within the state. These are only a few examples. The methodologies vary, but most follow the federal calculation with variations on the credit rate, refundable nature of the credit, as well as the carry forward and carry back provisions. And as of this year, these are the states that currently offer an R&D credit. Most of these states offer a credit on the same qualified expenses claimed for federal, so long as those activities and expenses take place within the state. And they may be claimed in addition to the federal credit. So if you or your clients are conducting R&D within these states, make sure you're looking into this valuable benefit as well. Something to note here, Arizona and Illinois both extended their credits, Arizona through December 31st, 2021, and most recently Illinois through December 31st, 2026. Oregon's credit is expired as of December 31st, 2017, so its credit only applies to tax years 2017 or earlier. And Virginia recently extended its credit through January 1st, 2025, and also increased the total credits available for that state. Now, R&D credits can be found in almost any industry. Here is a list of just some of the industries where research credits are commonly identified. Basically, if your client is developing something new or improving an existing product or process, regardless of the industry, they are conducting R&D activities eligible for the credit. This slide shows the most popular industries where companies are taking advantage of the federal R&D credit. No surprise probably that manufacturing leads the pack, followed by software developers, engineering, and scientific services. So again, if your client falls within any of these industries, there may be a great benefit here for them. Now, this is just a short list of some of the studies that we've conducted, and here are a few examples of the qualified activities for the different industries. So in manufacturing, in formulations, first on the slide, if you are formulating new organic foods, spices, beer, or wine, as long as you're experimenting with new ingredients and new processes or techniques, those activities and expenses will qualify for the credit. In manufacturing, if you're designing and testing new prototypes or experimenting with new processing techniques in order to gain a competitive advantage, those types of activities qualify as well. If you're in the software industry, developing software for back office applications, video games, mobile or web applications, or computer animation, those activities qualify for the credit as well. If you are a defense contractor and you're developing parts for systems on a ship, a plane, or vehicle, those activities and expenses qualify as well. A pharmaceutical company, if you're developing drug formulations or conducting testing for humans or animals, those activities qualify. And finally, if you're in the mining industry, you're developing innovative extraction techniques or delivery processes for the mining, oil and gas industries, they can qualify as well. So again, not an all-inclusive list, but something just to get your mind thinking, do I have clients involved in these types of activities? And if so, would it be worth a conversation at least to see whether there's a benefit for them? And now I'm going to turn it over to Mike. He's going to discuss what activities and who may qualify for the credit. Mike?
Thanks, Michael. So often when a reference is made to research and development, people tend to gravitate towards the thought of lab coats and test tubes. In reality, the R&D tax credit tests are much broader in application, and provided we meet the following tests, we have an opportunity to claim the credit. So for activities to qualify for the research credit, there are 4 tests that need to be met. These tests are applied at the business component level. It's important to note that a business component is defined as a product, process, technique, software, or a formula. So the first test is called technological in nature. This states that the project must fundamentally rely on the hard sciences, such as physical science, biological science, computer science, or engineering. The second test is permitted purpose. This has to do with the objective behind the research. The objective must be to improve the functionality, performance, reliability, or quality of a new or existing business component. The third test is called elimination of uncertainty. At the outset of the project, there must be a degree of uncertainty related to the appropriate design of the business component or the capability or methodology for improving the business component. And the fourth and final test, process of experimentation, works directly in concert with that last one, elimination of uncertainty. This requires that substantially all of the activities must constitute a process of experimentation, which is defined as the evaluation of alternatives to eliminate the technical uncertainty identified at the outset of the project. So in short, if we're developing a new or improved business component, our work relies fundamentally on a hard science, that there's some technical obstacle or challenge at the outset of our project we try and overcome through experimentation. We meet all 4 parts of that 4-part test and are able to capture the expenses associated with that project towards the research credit. Generally, there are 3 types of expenses which qualify for the research credit. They are wages, supplies, and contract research. Qualified wages are generally defined as the qualified portion of an employee's W-2 Box 1 amount. Qualified supplies are items that are used and consumed in the research process. For example, materials used in prototypes. Supplies cannot be capital in nature. Therefore, taxpayers cannot qualify land or machinery and equipment. Additionally, general and administrative expenses such as travel, meals and entertainment, and telephone expenses cannot be captured as qualified supplies. Qualified contract research are payments made to third parties for the performance of qualifying services. Generally, any payments made to third parties for the conduct of research on the taxpayer's behalf are eligible to generate research credits. However, it is important to note payments for contract research are subject to a statutory reduction. This reduction is typically 35%, but may vary depending on the type of organization, as you can see on the slide at the bottom. So now that we know what qualifies, it's important to understand who qualifies. So from an individual standpoint, right, we discussed we can capture wages or contract research efforts. There are 3 levels of qualifying activities from the employee standpoint when capturing wages. Primary level would be the individuals that are directly engaged in qualified research. These are the individuals that are working directly on the project. From there, taxpayers can capture 1 level directly above and 1 level directly below. 1 level above would be the individuals that are directly supervising these personnel. 1 level below would be the individuals that are directly supporting these personnel. So here are some examples of qualified direct supervision and direct support related activities. Direct supervision typically includes first-line supervision of direct research, reviewing technical designs, communicating requirements, and participating in technical meetings. It's important to note that direct supervisors can have both direct activities and direct supervision activities that constitute qualified time. So they can be directly involved in the efforts and directly overseeing them and capture both sets of effort towards the credit. Qualified direct support activities include things like documenting test results, maintaining and cleaning research equipment, compiling research data, and creating experimental models. So the determining factor for qualification is the nature of the activity to which expenditures relate. Qualified activities are applied at the business component level, as we mentioned before, and the qualified research activities are defined by that 4-part test previously outlined. There is something called the shrinkback rule, which applies at the business component level and is allowed to either take the business component as a whole or to shrink back to the smaller, more distinct component, which makes up the qualified product, process, technique, software, or formula. So we can take it at the full product level, or we can shrink back to the portion that we know qualifies. Qualified activities include all development-related efforts from initial concept to commercial release of a business component. Examples of qualified activities can fall under several categories, and this list is certainly not all-inclusive. Included in this list are activities in the design stages of a project, which includes things like specification design, technical design work, CAD design work, and modeling and analysis. Also, prototype development, which includes the design and construction of test products. Testing and experimentation is also qualified, and this would include things like computer modeling and simulation, prototype testing, and field tests. It is important to note that the success of the development efforts is not required in order for the project to qualify. In fact, when a development effort is unsuccessful from a technical perspective, it makes the uncertainties associated with that project that much more apparent. So we've gone through qualified activities. here's a list of some general non-qualified activities. First and foremost, non-qualified activities includes anything that takes place outside of the United States. It is a US-based incentive, and so the work must be conducted inside the United States for it to qualify. Additional examples of non-qualified activities includes things like any adaptation of an existing business component, or duplication or reverse engineering of an existing business component. So these would be things like minor changes made to an existing product, or once we've finalized the design on a product and rolled it out for production. Anytime we're duplicating it from there, those efforts no longer qualify because that's production related. Also, any activities around the social sciences or humanities is non-qualified. As you may recall, part of the 4-part test is that the efforts must rely on hard sciences. So also studies related to efficiencies or management operations, profitability, that would fall outside the hard sciences efforts and would not qualify. Routine data collection or routine QA testing is also non-qualified efforts. And additionally, funded research. So funded research is defined as research to the extent funded by any grant, contract, or otherwise by another person or governmental entity. In order for this type of research to be deemed not funded, so in order for it to qualify, the taxpayer must retain at least shared rights to the technology developed, and the taxpayer must be financially at risk for the development efforts. Whether these criteria are met is typically determined by the terms set forth in the grant or contract. So additionally, non-qualified activities includes activities that take place after the project is ready to be commercially released. The following activities are deemed to occur after commercial production: pre-production planning, pre-production tooling, trial production runs, troubleshooting production equipment, accumulating data related to production, and debugging flaws in a business component after it is commercially released.
So we're going to talk about real briefly a couple of the calculation methods and examples for each under the federal calculation, under the federal rules. So the federal regular credit is calculated as the sum of 20% of the company's qualified research expenditures. I'm going to refer to those as QREs for the remainder of the presentation. So the federal credit's calculated as the sum of 20% of companies' QREs over a base amount. That's why it's called the incremental. It's an incremental credit because you don't get the credit on what you're currently spending. You get the credit on the difference between what you're currently spending and what your calculated base amount is. So 20% of the company's QREs over a base amount plus 20% of basic research payments. These are payments that are made to tax-exempt organizations performing research on your behalf. So think in terms of universities, scientific research organizations, those types of entities. Plus 20% of payments made to energy research consortia. These are tax-exempt organizations as well, but they're performing focused energy research, typically funded by a small group of taxpayers with an interest in the results of the research. The credit is based on the qualifying activities conducted by the company or for those performing research on the company's behalf. This is primarily a wage-based credit. And I say that because the US reports that on average, 75% of the credit is generated from employee wages, and the other 25% split between qualified supply costs and third-party contract research. Now the credit, as I mentioned, is incremental in nature. So the idea is that you're spending more each year than your calculated base amount, and it's on that difference that you get the credit. But companies that are experiencing flat R&D spend can still take advantage of the credit using the alternative simplified credit method, which Mike will discuss in just a few minutes. So right now there are two federal calculation methods available, the regular credit or the alternative simplified credit or ASC. Both methods require calculating a base amount, which a company's current R&D expenses must exceed in order to claim the credit at the federal level. For the regular credit, this base period focuses on the years 1984 to 1988. Alternatively, if the company was not around during that time or if they weren't conducting R&D during those years, then the base period consists of activity occurring after 1993. So for the ASC method, the base amount involves only the 3 prior years' expenses. Now the election as to which method you're going to take is made each year on an originally filed tax return. Now once you make that election, you are stuck with that election for that tax year. So if the taxpayer wishes to change its calculation methods for a future year, it must be made on that year's original return. However, if you're amending a prior year tax return to claim the R&D credit for the first time, either method may be used. And you can go back to all open tax years in order to amend to claim the credit. There are 4 items necessary to calculate the regular credit. The first are the qualified research expenses, QREs. The average annual gross receipts for the 4 prior years is the next calculation that you'll do. Then you'll need to determine what the fixed base percentage is, which is defined as the ratio of aggregate QREs over aggregate gross receipts for a specific period of time. And the maximum fixed base percentage allowed is 16%. The base amount is the final calculation that you'll make, and that is to determine the base amount, you have to compare 2 numbers. First, you multiply your average annual gross receipts by your fixed base percentage, and that's called the tentative base amount. Then you take 50% of your current year QREs, and that's your minimum base amount. Now, whichever is greater, your tentative or your minimum base amount, is your base amount. So the larger of those 2 calculations is your base amount. This is the amount that your current year QREs must exceed in order to get a credit at all. Now the credit rate is then applied to that amount to arrive at your credit. And for the regular credit, that's 20%. All right, so next is an example, or is an illustration really, of a fixed base percentage calculation. This assumes a base period in the years 1984 through 1988, which means that the company was around during that time and was conducting research activities in at least 3 of those 5 years. And in this case, it looks like they were performing research in all 5 years. So to calculate the fixed base percentage, we total up the QREs for these 5 years and divide by the total gross receipts for the same period. For members of a controlled group, QREs and gross receipts for each member of that controlled group must be included in this calculation. So in our example here, the fixed base percentage is 2.3%. So in this example, we have a company with a current year R&D spend of $3 million. The average annual gross receipts for the 4 prior years are $75 million. We next compare the tentative base amount to the minimum base amount. The tentative base amount is the 1.725 million, which is the 75 million times the fixed base percentage of 2.3%. Comparing this to the minimum base amount, which is the $3 million in QREs times 50%, we see that the tentative base amount is larger, and therefore we use that as our base amount. Subtracting the base amount from our current year R&D spend yields 1.2 million in incremental R&D. We multiply this by the 20% credit rate to get the gross R&D credit, and again by 79% if the IRC Section 280C reduced credit is elected. So let's talk a little bit about that. The gross credit, so in this case, in this example, the gross credit is the $255,000. That must be claimed if you are claiming the credit on an amended tax return. again, if the 280C election was not made on that year's original return, then you must use the gross credit. Now, if the gross credit is claimed on either an original or an amended return, you must reduce the amount of the company's deductible expenses by the amount of the gross credit. So in our example here, if the regular credit amount of $255,000 is claimed on the tax return, then you must reduce your deductible expenses on that tax return by $255,000. Now, to avoid this, it's generally advantageous for companies to elect on an original return the 280C reduced credit, which reduces the credit by 21%, but requires no adjustments to be made to the deductible expenses. So what this means is that if you are now claiming the reduced credit of $165,750, you need not reduce the amount of your deductible expenses. This eases the administrative burden in satisfying the general rule that a credit and a deduction cannot be claimed on the same R&D expense. So I'm going to turn it back over to Mike. Mike's going to talk about the alternative simplified credit method. Mike?
Yeah, thanks, Michael. So yeah, as Michael mentioned, we just walked through the regular research credit method, and this is the second option for the federal credit calculation method, also known as the alternative simplified credit or ASC method. The ASC is calculated by applying a 14% credit rate as opposed to the 20% credit rate of the regular credit to the current year QREs that exceed a base amount. The base amount is the prior 3 tax years in this instance, and that is based on the prior 3 years qualified expenses. So it's essentially a trend of historical data comparing the current year to the 3 prior years. The ASC may be a great option for older companies which may not have records to support a regular research credit base period and fixed base percentages. Furthermore, companies with large gross receipts amounts in recent years could benefit from the ASC methodology as well. If you recall, the regular method is heavily reliant on gross receipts for that average 4 prior years to create that base amount. So as your gross receipts increase in your regular research credit, the base amount goes up as well, which reduces your credit amount. An important item to note, as Michael previously mentioned, you can amend returns to claim the alternative simplified credit method. It doesn't matter what method you're choosing when you amend, so long as you haven't elected that method or a different method in that year previously. So whereas the regular credit required a fixed base calculation and average annual gross receipts, the ASC method only requires the qualified research expenses, as I previously alluded to. So your qualified wages, supplies, and contract research for the credit year, as well as the 3 prior years. So that base amount is calculated by simply taking 50% of the average QREs from the 3 prior years. If we subtract that base amount from the current year QREs and multiply by 14%, we get our alternative simplified credit amount for the current period. So in this example, we have a company with $3 million of QREs. Its base amount is $1.125 million. That leaves current year QREs available of $1.875 million. We apply that 14% credit rate and get an alternative simplified credit of $262,500. If we elect the 280C reduced credit, this reduces the credit by 21% to get us to $207,360 or $375. Excuse me. Remember that the 280C election is only available on an original filed return, but it does have the benefit of providing an easy way to make adjustments or not having to make adjustments to your deductible expenses. An additional benefit to taking the 280C credit is that it provides a lower starting point for income when you're filing your state returns. So on this slide, we have a case study involving a software development company with a wage expense of $1 million, of which 500,000 qualifies. We would expect approximately $50,000 of federal research credits. And on this next slide, we have an example involving a manufacturer. So with wage expenses of $3 million, of which 800,000 qualifies, we would expect approximately $80,000 of federal research credits. So as you can see, the general ballpark estimate for a credit amount is roughly 10% of what your qualified expenses are, though obviously that will vary based on the set of facts and circumstances. But 10% is the rough ballpark. So.
All right, so we're going to wrap up. We're going to talk a little bit about a couple of tax planning items. So as I mentioned, as was mentioned during the presentation, electing the 280C reduced credit on a timely filed original return means that you do not have to reduce the R&D expenses by the amount of the credit. So that there are cases where you may not want to elect the reduced credit. So for instance, if you are in if you have a client that is a flow-through entity, let's say it's an S corp and the S corp shareholder is not in the highest tax bracket, you may want to do the analysis on that, whether to elect 280C on that on the form 6765. So what we usually suggest is that the CPA run the credit calculation both ways, as we always provide both calculations, both the regular and the alternative simplified credit method. But when it comes to the 280C election, we recommend that the CPA run that analysis to determine whether the election is warranted. Also, if you are in losses, you may not want to elect the 280C. It may not make any sense to do so. So the gross credit in that instance is more of a no-brainer when it comes to claiming the gross credit in that. Also, if you do have losses that are bumping up against an open tax year, let's say 2016 is still open, but 2015 is closed. If 2015 was a loss year, you may be able to go back, claim the credit for 2015, adjust any NOL carry forwards, or just the credit carry forwards, I should say, that would have been used in 2015. Any leftover credits can be applied to open tax years. And there's the revenue ruling that supports that line of thought. And then finally, we talked about AMT. So starting in 2016, eligible small businesses can apply the R&D credit against AMT, and that was really a big game changer. Those companies that had, particularly the shareholders of S corps that were in this AMT, paying AMT, were just having to bank their credits basically and carry them forward, and now they can be used up immediately. As far as any IRS audit considerations, I wanted to just mention that Treasury has an audit technique guide that is publicly available. It focuses on the areas that are commonly looked at under audit. And I'll just give a shout out to KBKG's deliverable. We seek to address the most common questions that the IRS asks when conducting its audits. So our deliverable is, I won't say audit proof, but it certainly is, it gives you a leg up or a great head start in the event of an audit, that you'll have the answers to the questions that we're anticipating. Secondly, the IRS continues to target the use of estimates, even though the courts have ruled time and again that credible estimates may be used to determine qualified expenses in the credit year, as well as the base years. And also oral testimony, so long as it is credible, may be relied upon to determine qualified activities surrounding its business components. And then finally, documentation supporting the R&D activities as well as the expenses related to the development continue to be a major focus of IRS audits. And what we're really trying to do here is to, with the documentation, substantiating documentation, is to support through contemporaneous documentation the nexus between the activities that were being performed and the expenses that are being claimed. And to that end, I have attached the final slide here is a list of the most common contemporaneous documentation examples that we find across really all industries. You'll see many of these are maybe manufacturing focused, but also some are software development. But basically, what I try to advise my clients when it comes to documentation, we don't want you creating any documents to support your position. This is supposed to be contemporaneous with the activities that you're claiming the expenses for. So we would work with you to determine what types of documentation is generated at different stages of development. What do you maintain, and what can be the best documentation to support your claim? One thing I will say is that oftentimes it's not the project documentation necessarily that we're after. You want to look at where your QREs are. What's driving your credit? Is it an owner's wage amount? Is it a qualified supply? Perhaps you created a first of its class prototype in the entire industry, and it cost you over $1 million to in parts and materials to be able to put that together. There's a case to be that case it could be a slam dunk, but you've got to substantiate that through documentation. So what I would suggest is letting the QREs guide you to the documentation that is most relevant in substantiating your credit.